All right, so we are going to do some accounting just to show you that what the person who does accounting for you, or if you want to do it yourself, this is not rocket science. Model was created in 15th century by a monk. Did they have tablets in the 15th century? Did they have iPhones, smartphones, cars? They didn't have these things in the 15th century, correct? Did they have indoor plumbing? No. So these barbarians could understand this. You with indoor plumbing could understand this. It's that simple. If they could understand this, you could understand this. All right. It's maths. He was a mathematician. From the very beginning, it was created to figure out how is the business doing. Before Lucas' creation, to understand business performance, you would have to shut down the business and count up everything. Count up all your assets, check all who you owe money, count everything, and then you would know, okay, the business suffering, we're doing well, etc. Luca found that to be very inefficient. And because he was a monk in the 15th century with no electricity, nothing to do in the night, he decided to solve the problem. He didn't have cable. Right? So, he came up with the idea that if you develop a system of records and you build integrity into the records so that you trust the records, then I don't need to count. What do you do when you want to know your bank balance? What do you do? You go online, you call the bank, you go into the bank over the counter, you go on some app on a phone, and you believe it. You don't actually see your cash, correct? That is Lucas' system. A system of records that has integrity. All right. He was a mathematician, so he understood you needed data. The data for this system is called a transaction. But not everything is a transaction in accounting. It must be measurable and it must have evidence. So, if during the week you pick up the phone and you order food, if you create an order, a purchase order in your business, you pick up the phone and you order some fabric, that is not an accounting transaction. Think of it. You ordered food or you ordered fabric. What happened? Anything happened? Nope. Nothing actually happened. You're still hungry. Legally, something happened. There's some sort of contract, a PO, that is legally. But for accounting and finance, nothing happened. When the product is delivered and you accept it, now something has happened. You have gotten inventory and you owe someone money. Evidence, measurable. So not everything that happens is recorded, is not an accounting transaction. Accounting equation, we just met it. A is equal to L plus E. Luca built this model on that equation because he was a mathematician. If you think of it, well, we did this already. If you think of it, in order for A equal L plus E to stay in balance, every transaction must affect both sides. Think of the equation. If something only affects one side, it will go out of balance. For A to equal L plus E to stay like that, each activity has to have two sides to it. And that is where the word double entry accounting system came about. Take off the top of the cross and you have a T. So Luca created a vessel, a T account. where on one side you put increases, on the other side you put decreases, and the difference is the balance, right? So we're going to do exactly what you just did, but we need a rule to operate the T account. There's your T account. For no good reason, absolutely no reason, he called this side the debit side and that side the credit side. That is the problem with people with debit and credit. They feel it have a logic to it and they want to reason it out. No, he wake up the morning and said, this is debit, this is credit. All right? But he created some rules, and the rules are what's important. Where am I, baby? Oh, come on. Right. So for assets, he said, remember you just did increase, decrease, increase, decrease. He said for assets, I will write increases on this side. For liability, no, it's an equation. When I take stuff across the equation, what happens to the signs? They change. So for stuff on this side, increases are on the right side and decreases on the left side. For stuff on this side, increases are on the left side, decreases are on the right side. So you're going to do the same thing you did with increase, decrease, but now we're putting it on different sides of these T accounts. Let me explain it. When you put money in the bank records that it owes you the money. You are a liability to the bank. So the bank credits your bank account because it is not your bank account. It is the bank's record that it owes you money. You want to use the bank's records for your personal records. When the bank sends you a bank statement, which we'll get into, that is their records. You are supposed to have your records and compare it because they make mistakes. So that is why they credit your bank account. It's not your bank account. It's their account. And you are a liability to them.